14, Market and Economic Overview. What you're seeing on your screen says Quarterly Market Review, but we will focus on the year 2014. This is Mario Nardone of East Bay Financial Services. I appreciate your interest in viewing the recording today. It is nice to be back working with old and new friends alike. You had recently received a communication from Kira to remind you that I had the privilege of working with MFC and its clients for almost 4 years as Chief Investment Officer and Chief Compliance Officer. And Kira and the team have been extremely supportive through the twists and turns of my professional career. And all through that time, as you may know, we never stopped learning from each other and sharing best practices in a number of ways. And now, again, as Kira reminded you, I have my own firm, East Bay Financial Services, where I work with individuals and institutions, but also collaborate and consult with financial planners and their clients. I'm extremely happy and excited to have the opportunity to once again work with MFC in that capacity and look forward to working with you all once again. After this call, please direct all questions and comments on this new development to the MFC team. But as usual, please keep all complaints to yourself. Just kidding. Now, some of you are familiar with this format. It's a quarterly review, like I said. We're going to focus on the year 2014. It's a little overdue, so I'll try to bring us up to date wherever it's relevant. The purpose is to make sense of economic data, how it impacts and influences our strategies, as well as for educational opportunities for our clients and friends. We'll have plenty of time for Q&A. Your phone lines are on mute for now, but we will offer opportunities to chime in and ask questions as we go along. It should take no more than an hour. If you need to jump off the call, no problem there. We'd be happy to follow up with you with anything you might have missed later on. So just a little overview of what we're going to discuss. The first 3 slides are really going to be some broad-based overviews of how the markets have performed in general. And then we'll take some deeper dives into various categories and various subcomponents of equity, fixed income markets, as well as some other investment categories like real estate and commodities. At the end, we'll finish with a perspective slide from one of our investment managers, Dimensional Funds, with whom Kira and I have the opportunity to engage quite frequently and actually had an opportunity to meet with our representatives yesterday. So we always stay on top of what's happening at Dimensional Funds and any of our investment partners. So just to give a broad overview of what occurred in the 4th quarter, can anyone remember that far back? If you recall, in the news, the real main stories were oil prices in a precipitous decline, and the Ebola crisis in Africa was a close second. Against that backdrop, we had mixed returns of global stock markets. Here in the U.S., we actually had a pretty positive 5% return. Now, again, that's just the 4th quarter. So if you extrapolate that for a full year, that's a 20% return, which is certainly an above-average return. In the international markets, we had a decline. We'll talk a little bit more in detail about the reasons that we saw those decreases in value, and that most of it is due to currency. Global real estate, in this case, we're talking about commercial real estate, was extremely positive. Again, on an annualized basis, that's something like 40%. So we're talking about commercial, office space, apartment buildings, retail space, and that sort of thing. On the bond side, we had pretty normal-looking returns, maybe not what we expected, but 2% per quarter from bonds is within the realm of expectations in general and over the long term. Global bond markets were more positive than historically and what we might expect at 3% just for the quarter. To look into the path that global stock markets took over the 4th quarter, this chart shows the value of the MSCI All Country World Index, which is a measure of global stock markets. And below, what they've done in this slide is to overlay various events and market fluctuations. Now, it's not really trying to make a statement about causality, but let's just look at the volatility, even through a period like 1 quarter. From the beginning of October, the markets in general took about a 5% decline, then a 7% jump, another 5% decline, and then about a 2% increase to pretty much finish where the quarter started. So this is a good illustration of stock market volatility in the short run and why you really shouldn't put too much emphasis in your decision making on what happens day to day, month to month, or quarter to quarter. But in looking at some of these overlay headlines, what really stands out to me are how many of them pertain to the consumer. So let's start in the middle here where it talks about oil prices tumbling to 5-year lows. Now, if there is any causality, the market didn't like that very much, but that's pretty good for us as a consumer. Prices at the pump under $2 a gallon is pretty good for our pocketbooks, especially around the holidays. So that's positive. And then you see that that has translated into consumer sentiment, highest in 8 years, another good thing. U.S. restores Cuba ties in a historic deal. Again, that's great. We want trade with our closest geographical neighbors. That's a good thing. Now, the dollar is going to be a major theme throughout the course of this presentation. And this headline here, the dollar ends its best year in more than a decade. Again, certainly very good for us as consumers because our dollars go further in purchasing the stuff that we like to buy that's made elsewhere. Now, and in the short run, that's a good thing. But there is a downside to that as investors, and we'll talk about that in a minute. But in terms of the stock market, this headline really says it all. The Dow has its longest annual winning streak since 1999. Now, many of us are still feeling, that our investments may not have fully recovered, or we have some concerns about what's going on in our portfolios, but it really has been a pretty good run recently. Ultimately, what we want to remind you about on this slide is that all these fluctuations occurred in a 3-month period. Really strong proof that in the short run, prices are driven by changing expectations and the relative struggle between fear and greed in market participants. But in the long run, we have to remember that returns are driven by corporate profitability. So again, one more reason why we like to ignore the noise, pay attention to it. I shouldn't say ignore it. Pay attention to it. Really pull out the parts that matter in the long run, but recognize noise when we hear it and not be emotionally responsive to it in our strategies. This slide, we're not going to spend too much time on it, but really just to explain it, it takes various parts of investment markets and ranks them from the best performer to the worst. So the best, as we talked about earlier, REITs are commercial real estate investments, and at the bottom, we really see mostly international stock markets, which we'll get into in a bit. So to take a deeper dive into the U.S. market, again, remember that stocks represent ownership of a corporation, and owners of a corporation are essentially entitled to a share of that company's future profits. Throughout the slide, and if you're watching the webinar, feel free to pause and rewind if there's a comment that needs a little bit more thought, and feel free to follow up with questions as well. You'll see this word cap, and what cap refers to is the capitalization of a company. And capitalization is the combined value of all outstanding stocks in that company. So when you look at small cap, that essentially means smaller companies. Large cap means larger companies. And if you look at the fourth quarter, you see that small cap categories, small cap stocks, outperformed larger stocks. Now, this will always be important to our strategy. I shouldn't say always, but very likely to be important throughout the ages in that MFC and myself and our partners at Dimensional Funds have done a lot of work and research that proves out that smaller companies tend to perform better than large companies over time. And you would expect that. Take a little bit more risk, you're rewarded with a lot more return. We diversify that risk in other ways, but essentially in our stock portfolio, we tilt towards smaller companies. So fourth quarter was a good year for that strategy. But to be perfectly honest and straightforward, the year 2014 wasn't great for the small cap tilt. If you might have been paying attention, you heard that the Dow Jones has broken records for annual returns, and you see that here in this slide. Large cap stocks returning between 12 and 14%. Smaller companies have not fared so well, but what we're talking about is investments over the long term. And even though 10 years might be considered the long term, even in this period, the results aren't as compelling as they are when you look at much longer periods of history. But even in this 10 years, you do see a slight advantage for small cap versus large cap to the tune of about 10 basis points per year. Now again, bringing us up to speed in 2015, small and large companies have been pretty equal in return. As of yesterday, both were up in the 2% range. Turning our attention away from the domestic market and now looking at international developed nations. And just to clarify, developed are typically defined as mature markets, those with very strict regulations and monitoring of the orderly performance of markets and banking institutions. These are countries like Germany, Australia, Japan, and Canada. The upper right graph here needs some explanation, in my opinion. What you're seeing here are the same returns, just one of them, the lighter shade, is expressed in the local currency or home currency of the companies in that particular index. The dark shaded box or figure is those same returns expressed in US dollars. So essentially, as a dollar-based investor, the return that we would receive is the U.S. currency return. If we were an investor in Germany or France or any of the nations I just mentioned, their return would have been positive 3% in this particular case. Now what that tells us, as I mentioned earlier, is that the dollar strengthened over this period. Now at first glance, that may seem counterintuitive that the dollar increased. Well, why is my return lower? Well, the reason is because the theoretical return that you're looking at assumes that we have traded in our dollar at the beginning of that period and invested in a foreign asset, a foreign stock. And then the theoretical flip side or end of that period, we sell that foreign asset and buy back our dollars. So if the dollar strengthened over that time period, we would have been selling low and buying high. So even though our investment had a positive return, the dollar makes it look like it was a negative investment. So to bring that full circle, as I mentioned earlier, a strong dollar is good for us as a consumer, but it's bad for us in the short run as an investor. But again, all these numbers are hypothetical. Unless you actually did buy and sell at the beginning and end of this period of measurement, then it's really just hypothetical. Now, over the long run, if we look at the one-year period of 2014, I should say, international, especially small cap and value, which means we're buying stocks that are at a discount to their book value, was also a big story for our portfolio, and again, will be for at least the foreseeable future. Although it's not a concern, the investments themselves, again, were solid. Most of the negative performance that we're seeing here is due to that currency effect, whereas in the fourth quarter, the dollar strengthened to the tune of about 5%. Over the year 2014, the dollar strengthened about 12%. So if you factor that into these one-year numbers, the underlying investments actually performed quite well in the 7 or 8% range. But again, as U.S. investors, it just looks negative. Certainly, this is not a reason to not want to invest in international companies. It's just something we need to deal with over the short term and prepare our clients for. If you have any questions about that, feel free to follow up with us in an email or a phone call. Again, bringing us up to date in 2015, developed markets are up approximately 6%, including the currency impact. Turning our attention to emerging market stocks, whereas earlier I mentioned developed markets are Germany, France, Canada, Australia. Emerging markets are less mature markets, those that don't necessarily have all the safeguards in place in their banking institutions or their stock markets, or there might not be such tight regulation, or they might have some political, not even turmoil, but disorganization or what have you, to the point where index providers have deemed them emerging markets. Now, we're talking about countries like South Africa, Mexico, and Taiwan, where we know that there are great companies that are based in these countries and that do business all around the world. So even though there might be some additional risks of investing in emerging markets, what we're talking about here are investing in strong companies within those markets. And again, diversifying that risk through other investments in the portfolio. And just for a point of clarification, we do not have a very high exposure to this type of investment, currently targeting about 5% of most client stock positions are in emerging markets. Now, not to belabor the point, but we still have a very similar currency story. Again, a 5% decrease in return due to the strengthening dollar. The difference here comes in over longer periods, where emerging markets have lagged for a longer period of time. You see 5-year returns under 4%. Now, this is where our strategy at MFC has helped us, having an underweight to emerging markets relative to its global weight of 10%. So that's actually been a little bit helpful over the last 3 to 5 years. But again, we believe that this is a place we want to invest for the long term. So far in 2015, emerging markets are up about 3% as of yesterday. This slide breaks down the markets into individual countries. And we don't really focus too much on individual countries. We certainly need to watch the global economy. And right now, Greece is a big deal, and we certainly want to know and see how that plays out. But in general, we're not going to make investment decisions based on individual country expectations. But one thing I did want to point out, the most probably interesting part of this slide is, we talked about oil prices, and the decline of oil prices was the biggest issue in late 2014, and Russia being the one country that's probably the most closely tied to the price of oil, including its currency value, was the worst performing country in terms of its stock market in the fourth quarter. So you can clearly see the relationship there. Now let's take a deeper dive into these things called REITs, Real Estate Investment Trusts. Again, these are holdings in commercial real estate that are professionally managed by a company, a group of managers, that focus on assets like apartment buildings, office space, healthcare, even self-storage facilities can be organized as a REIT. Just like emerging market, MFC has about 5% of our stock portfolio focused in this category. And the clearest thing worth discussing on this slide is the huge dispersion between the returns of REITs based here in the U.S. and those based outside the U.S. Now, in this case, we see the U.S. market significantly outperforming the global market. Now, you still have that currency effect of about 5%, but the bigger difference is attributable to the fact that real estate, specifically commercial real estate, is much more closely correlated with economic growth of the country. And if you think about it, it makes sense. And when I say more closely correlated, I mean more closely than stocks. A lot of people think, oh, GDP is up 3%, the stock market should do great. There really isn't a big correlation, and the correlation that people would expect. But in REITs, there is absolutely a better correlation, and if you think about it, it makes sense. If the economy is doing better, then think about office space. More people are being hired. Office space is being filled. So REITs, in turn, should perform better. And that's just one small example, but this is something we should expect over time. So in that case, and over this period, the 1 to 3 year period included, even over 5 and 10 years, the U.S. REIT category, which is where we're focused in our portfolios, has performed significantly better than the rest of the world. Part of its outperformance is also due to investors' appetite for yield-oriented investments. Now, that's not why we're in there, but we do like the consistency of income that REITs throw off. But we do need to be mindful that some of this outperformance may trail off as interest rates normalize over the coming years and maybe decades. So far this year, U.S. REITs are up about 5%. Commodities, again, we're not going to spend too much time here. We don't look at the individual price of soybeans and pork bellies and things like that. So what's important, though, is that we are in the process of exiting most, if not all, of our direct commodity exposure in client portfolios. This is certainly not anything to do with timing, but we have dissected the evidence, and the evidence clearly shows that over the long term, holding commodities does not necessarily improve returns or reduce the risk of an overall portfolio. We had a very small allocation to commodities, which are typically, the exposure is typically obtained through futures rather than holding these things directly. And we could talk about that in detail, but mostly we just feel like over the long term, investors are better served by holding other types of investments. This slide is titled Fixed Income, and we just want to make sure that in this case what we're talking about is fixed income, which is also known as bonds. We just call it that because in general bonds pay a fixed coupon for its lifetime. So think about bonds on this slide. And we want to start by focusing your attention on this graph in the middle, and what it's titled U.S. Treasury Yield Curve. And all this really means is at each maturity range, so a 1-year Treasury bond, a 5-year, a 10-year, or a 30, these are the various coupon payments that an investor in these Treasury bonds would receive today. And the 3 lines show you various periods in time. In this case, we see the end of December, and then we see where the curve started at the beginning of the 4th quarter and where it was a year before. So we see that even though in December of 2013, most people were saying yields can't get any lower, well, what did they do over that period? They got even lower. And we have to remember that when yields rise, bond prices decline, and vice versa. And again, that is a main driver in why people care so much about currently low Treasury yields, in that if yields can't go much lower, then the only way they can go is up. And the fear is that if that happens quickly, there's going to be potentially the type of bond price decline that none of us may have seen in our lifetime. Now, does that mean we need to panic or run away from bonds? No. In fact, it'll actually be better for us as investors when yields rise, even though there might be some short-term pain. In other words, I would rather have a bond that goes from yielding 2% to yielding 4% for the remainder of my investment horizon, even if I have to suffer with a 4 or 5% decline over the period it took to get those change in yields. And we need to have that mindset and expectation. Here at MFC, in our portfolios, we are looking out at this and at the landscape in bonds and attempting to mitigate the short-term pain of that price increase by emphasizing short-term bonds as well as diversifying into some international bonds as well, which should be less susceptible to rising rates here in the U.S. We also do that by investing in other categories of bonds, not just treasuries. And this graph here shows a little snapshot of that, where the 10-year treasury yield is 2.17. Other categories like municipal bonds and various categories of corporate bonds still offer slightly higher yields. So we are invested in these categories as well in most of our client portfolios. There's a lot of data on this page, but really the main index for U.S. bonds is the Barclays U.S. Aggregate. So if you look at that, you'll see that bond returns have been normal, maybe slightly below long-run averages over the last 3, 5, and 10 years. The long-term average is probably around 5 or 6%. So maybe we're a little bit below that due to these lower yields, but eventually those should normalize. Now this slide here really is just a demonstration to show the path that various asset mixes move over time or have moved over time. So what it shows is if you just had a portfolio of bonds of very low-risk treasury bills, so short-term treasury issues, this would be your return. Yes, it's very smooth, but no, you're not getting a heck of a lot of return. And we're looking at a very long time period here. Now, as you add stocks to that portfolio, so 25% stocks, 50, 75, and 100, your rate of return obviously improves, but the path that it took to get there is a lot more volatile. So that's why we say and believe and really spend a lot of time with clients to determine the appropriate asset allocation, so that we look at your time horizon, we look at the rate of return that you're required to achieve your financial goals, and then we don't take any more risk than you have to. So for the person who really just needs to be at this point at the end of their investment horizon, why take on the additional risk when you don't necessarily need to? Because if we happen to invest at a high point in the stock market and our timing is bad, even though we're not trying to time the market, there's no way to predict that. So why take that additional risk, again, if you don't have to? So the last slide in the presentation is simply an observation or an article, if you will, to put the volatility we mentioned on slide 1 or early in the presentation into perspective. This article was written by Dimensional Funds, and I'm not going to read it. I'm not even going to review it, but as you are listening to the recording, I do suggest that you pause the replay, take some time, read it over, let us know if you have questions about it. But if I could call your attention to one particular point, it's number 6, that discipline is rewarded. Now, certainly as you watch your account values go up and down, specifically down, this statement may be true for you that the market volatility is worrisome. But if you're diversified, if you understand that this is how markets work, and if you stay the course and don't panic when times are rough, then, again, it puts it into perspective, and we have faith that capitalism will prevail, that companies that we own will return to profitability, and shareholders will be rewarded. Then we remind ourselves that we are doing the right things and making the right types of investments to secure our financial future. And with the last 3 words, with that, relief replaces anxiety. So that's the end of the formal presentation. I hope it was helpful and maybe thought-provoking, and if you have any questions stemming from it, feel free to reach out to your contacts at MFC, and they would put you in touch with me if and when necessary, and I look forward to speaking with you on future webinars or potentially in person. And once again, I really look forward to serving you once again. Thanks.